Hello, everyone. Welcome to the One Big Beautiful Bill Act and its impact on your taxes. My name is Luis Rosa. I'm the CEO and founder of Build a Better Financial Future, which is a financial planning and investment management firm currently based out of Las Vegas, but working with clients throughout the country. This bill was recently passed into law and it has a huge impact on your taxes. And it provides great opportunities for you to do some planning, yet still in 2025 to better optimize your taxes. So let's dive into it. I'm going to share my screen and get into the slides. All right, before we get started, I'd like to introduce our team. So this is me on the left. We also have Catalina, which is another advisor on the team. We have Allison, which is the operations manager, and Pam is our strategic advisory board member. Before we get started, just a quick disclaimer. This is for information and educational purposes only. Please consult with your own tax advisor, financial planner, and/or legal counsel before you implement anything that you learn here. Before we talk about the bill itself, I think it's very important for you to learn some basic concepts that will help you understand both your personal taxes and also how the changes in the bill impact them. So let's talk about some basic things. A lot of things you're going to hear about in this particular bill affect either deductions or credits. So what is a deduction? A deduction is an amount you subtract from your income when you file your taxes so that you don't pay tax on that amount. And I'm going to show you how that looks in a 1040, an actual tax return form. So by lowering your income, the deductions lowers your tax bill ultimately, right? So give you an example. If you have a $1,000 deduction and you're in the 22% tax bracket, you pay $220 less in taxes because it's a deduction, right? 22% of $1,000 is 220. The IRS gives you the opportunity to either take a standard deduction or to itemize your deduction. The standard deduction is a fixed amount set by the government that varies based on your filing status, and I'll show you what those are. Itemized deductions is a method that you use in order to subtract specific eligible expenses individually, and I'll show you what those are, some of the most common ones. So you would choose your itemized deductions if your total eligible expenses are higher than the standard deduction, because the bigger number, the less taxes you pay. So here's an example of the standard deductions in 2024, which is the most recent tax year that was filed. 29,200 for couples that are married filing jointly. We also have head of household 21,900 and 14,600 for single or married filing separately. In addition to that, seniors 65 or older are eligible for an additional deduction because of their age and or if someone is legally blind. And those amounts typically change year over year. Now, let me show you what the deductions were for 2025 before the bill. So this is from kitces.com. They did a great job just highlighting the difference between the 2 years. It's 15,000 for single, 22,500 for head of household, and married filing jointly, $30,000 was the Tax Cuts and Jobs Act, which is set to expire as of December 31st of this year. Now, the new One Big Beautiful Bill Act increases those slightly. So you'll see 15,750 for single, head of household 23,625, and 31,500 for couples that are married filing jointly. Let me show you what that looks like on an actual tax return. This is a 1040 from 2024. This is a single individual with income of 237,332 under W-2. You will notice on line 12, the standard deduction in 2024 for single individuals, $14,600. So although this person made 237,332, he gets to subtract $14,600 to have taxable income of 222,732. So in other words, he saved taxes on that 14,600. That's what a deduction is. It gets deducted from your gross income in order to arrive at your overall taxable income. Then I'll show you what it looks like when you itemize your deductions. So let's get into those next. Itemized deductions are commonly things that you can use in order to couple them and hopefully they exceed the standard deduction. Most common ones are mortgage interest. If the mortgage interest was used to purchase the home or improve it as well, right? Property taxes, medical and dental expenses that exceed 7.5% of your adjusted gross income, charitable donations as well. And there are some changes to those. So I'm going to talk about that in a few minutes. So let me show you what that looks like on an actual tax return. So this is a couple that had $136,278 in income. They also had 41,497 in interest from the bank, plus some qualified dividends, and they had some capital losses and so on. But if you look at line 11, this is their adjusted gross income was 175,223. Now you'll notice on line 12, if you recall from the previous example, the other gentleman had 14,600 because it was single and that was a standard deduction. This couple has $56,512 of itemized deductions because they paid property taxes, they paid mortgage interest, they had medical expenses over 7.5% of the adjusted gross income. They had charitable contributions as well. So in their case, because their itemized deductions were higher than the standard deduction that the government gives you, you can take the larger number and you'll notice how instead of paying taxes on 175,223, it actually goes down all the way to 118,703. So that's what a deduction is. You get to reduce your income to arrive at taxable income. Now let's talk about credits. A credit, on the other hand, is a dollar for dollar amount that taxpayers claim on their tax return in order to reduce the income tax that they owe. Eligible taxpayers can use them to reduce their tax bill and potentially increase their refund. Some credits are what they call refundable, and some credits are non-refundable. The refundable credit means that not only can this credit bring your total tax liability to zero, but you can actually get a refund of that and get money back. Non-refundable credits can only bring your income tax liability to zero, but they do not give you a refund. So if you have any excess amount, some of them allow you to carry it forward to the next year. Some of the common examples of credits are the child tax credit, clean vehicle credits, energy efficient home improvement credits. Those are also being impacted by this bill. There's adoption credits. There's a lot of different credits, but these are a dollar for dollar amount. So if you remember the example I gave you of a tax deduction of $1,000, that only gives you $220 savings at the 22% tax bracket. If I give you $1,000 credit, you get literally $1,000. So if your tax bill was $2,000 and you have $1,000 credit, you only owe $1,000. So you would prefer a credit over a deduction in this case. And let me show you how that looks again in a 1040. So the total tax bill on this tax return was $16,219. This was the amount due as total tax based on their income, their taxable income. However, they have a child tax credit or other dependent credit, in this case of $500. So you'll notice that it reduces the taxable amount to $15,719 instead of $16,219. So in this case, let's say if this couple had purchased an electric vehicle and gotten the $7,500 credit, it would have reduced their tax liability significantly, right? Because it's a dollar for dollar amount. So that's the difference between credits and deductions. Now you know what a standard deduction is, you know what an itemized deduction is, and you know what a credit is. So I think this will help you truly understand the differences for what's happening with the changes in this bill. So now you're a pro as far as deductions and credits. Let's get into all the changes in the bill. So I broke this bill up into three separate sections that I'm going to show in this presentation. One of them is the temporary breaks. The other one is what's being made permanent. And the final one is what's being changed and or going away. And I'll show you what those are as well. So let's start with temporary breaks. So there's a certain amount of breaks that are temporary for the years of 2025 to 2028. These are tax years 2025 to 2028. You probably heard a lot about a whole bunch of things in the news, like no taxes on tips, no taxes on overtime, no taxes on Social Security. None of those three things are 100% true. A form of those things made it onto the bill. So I want to provide some clarification for you. So let's start with deduction for tips. You can deduct up to $25,000 in tipped income. In other words, if you have tipped income, when you file your taxes, you can reduce the amount of tips that you received from your overall income in order to arrive at your taxable income, similar to as you've seen with the standard or the itemized deductions, right? And in addition to, which is great. Now, there are some limitations. So this starts phasing out at $150,000 if you're single, or $300,000 if you're married filing jointly of modified adjusted gross income. So it starts getting reduced by $100 for every thousand over that threshold. And I'll show you an example so you see what that looks like. One thing to notice is that this is not reflected in your take home pay. So if you were getting tips via your paycheck will continue to look the same because taxes will continue to be withheld from your paycheck. You will only see the difference at tax time when you reduce that tipped income from your overall income, which will likely result either in a bigger refund and or owing less if you were going to owe. Now, something that's important to note is that you are still subject to pay FICA taxes on that income, which is Medicare and Social Security. So the exemption is only for federal income tax. So some things to consider as well. The taxpayer must work in an occupation that traditionally and customarily receives tips for 2025. The IRS was mandated to create a list within 90 days of the bill. So sometime in October, the IRS will provide a list of all of the occupations that qualify for this tipped income deduction. Another thing is that depending on your filing status, you can deduct up to $25,000, except if you're married filing separate. The IRS says if you're married, you must file a joint return to claim this tipped income, which tells me that if you're married and you file a separate return from your spouse, you're not eligible for the tip deduction. So if you typically do file a married filing separate return and you get tipped income, consider what it would look like if you're married filing jointly to see which one works out better for you. All right, so you can discuss that with your accountant. Also, the tips must be voluntarily and not mandated as part of the service provided, with the amount determined solely by the payer. And the tips must not be earned through what's considered an SSTB, which is a specialty service trade or business. These are a list of professions like lawyers, accountants, financial advisors like myself are excluded, musicians, artists, and entertainers. So if I, as a financial advisor, get tips, I can't take the tip deduction, right? So it's only a certain level of professions that will be provided on a list by the IRS. If you're self-employed, if you own a business, tip deductions is limited to the net business income. And this is available whether you itemize or not. So if you take the standard deduction or you itemize, and then on top of that, you get tipped income, you can take the tip income deduction as well, which is great for those that are getting tips. Now, let me show you an example. Let's say Jane is a single taxpayer with $200,000 of modified adjusted gross income. If you recall, the limit is $150,000 for the full eligibility. So she's already $50,000 over in income. So it starts phasing out. She received $20,000 in tip income. So the way you do the math is remember that every dollar over that is going to create a reduction, right? So when you do the math, it's going to give her a deduction of $15,000 as opposed to 20,000. She can't take the full amount because that $50,000 divided by 100 times 100 divided by 1,000 times 100 will give you $5,000 of amount that you cannot exclude. So in her case, instead of 20, it goes down to 15, right? So that's how the phase out works, right? So you can still take a partial deduction if you go over the 150 or the 300,000 for couples that are married filing jointly. Now, let's talk about the deduction for overtime. Very similar to tips. So the same income phase outs, 150 or 300. Also not eligible if you file married filing separate. However, the key distinction here is that they did break it into individual versus married filing joint. So as opposed to tips where you can just take the full 25,000, if you're single, it's 12,500, and if you're married, it's 25,000. So they made that distinction there in overtime. Another key distinction is that It's only the eligible portion that is over your base rate. So I'm going to give you an example. It's not all of your overtime income that's eligible. And again, these are going to be subject to FICA, which is Social Security and Medicare. So it's only an exemption from federal taxes. Also important to know, this does not affect your take-home income. If you have overtime pay, your check will continue to look exactly the same because taxes will continue to be withheld from your paycheck. And when you file your tax return next year, then you can deduct the amount eligible from your overtime pay. So let me show you an example of what that looks like. Let's say Mark is an administrative assistant who earns $50 per hour in base wages and $75 per hour of overtime, right? So we have time and a half, right? 50 times one and a half is 75. So he gets an additional $25 in overtime pay. That $25 is eligible for the deduction, not the 75. So your base wage is still subject to income taxes. So this year he worked 20 hours for overtime, earning $75 times 20, which is $1,500 in total. Of this amount, the portion that corresponds to the base wage, right, the 50 times 20 hours equals $1,000. He cannot include that in his deduction. So only the additional amount of $520, 20 hours times the $25 an hour equals 500. And that's the portion that he gets to deduct from his overall gross wages to arrive at taxable income. Another temporary change that's also from 2025 to 2028 is the car loan interest deduction. You can deduct up to $10,000 in interest on a vehicle purchase within those years. It has to be US assembled. It has to be a personal use vehicle, not for business or resale. The gross weight has to be less than 14,000 pounds. RVs, ATVs, trailers, and pre-owned vehicles are not allowed. And this is for new loans that were taken out after December 31st, 2024. So a little caveat to this is if you already have a loan that was taken out prior to December 31st, 2024, you could in fact refinance your loan as long as you don't add more to the principal. And now all of a sudden that new loan then is eligible for you to deduct that interest. Now, if you do some simple math here, I don't know that this will be something where a lot of people are going to get to deduct the full $10,000 because even at 5% interest, for you to pay $10,000 a year in interest, you would have to have a $200,000 loan. Now, a $200,000 car loan is huge, right? And because of the income limits, it's 100,000 for single and $200,000 for joint. I don't see how someone that makes $100,000 is driving around in a $200,000 car, right? Twice their salary. Now, I'm sure there are some people out there that do that, but I don't think a lot of taxpayers will get to deduct the full 10,000. Maybe a couple $100 here and there. So you take what you can get. Then it completely phases out at 149,000 for single and $249,000 for couples that are married, filing joint. Now, the next thing I want to talk to you about is Social Security taxation. There was a lot of talk about no taxes on Social Security. That also is not true. You could still potentially pay taxes on Social Security. Let me show you how that works. This is directly from SSA.gov, from the Social Security Administration's website. If you are single, an individual, and your combined income exceeds $25,000, you start paying taxes on a portion of your Social Security benefits, all the way up to potentially on 85% of your Social Security benefits, you could pay taxes on, depending on your bracket. If you file a joint return as a couple that's married filing jointly, after $32,000 in combined income, you start paying taxes on your Social Security benefits. So, in other words, people that typically only receive Social Security and they're either single or married jointly are probably not going to pay taxes on their Social Security. But if you start having income from other sources, like a pension, or you're taking money out of a 401k or an IRA, or you're still working and you make over these amounts, you're going to trigger taxation on your Social Security benefits. If you're married filing separate, you're probably going to pay taxes on your Social Security because married filing separate gets worked out differently. Usually, under married filing separate, you lose certain tax breaks, including one of these. Now, combined income is described according to them as your adjusted gross income, tax exempt interest, plus one half of your Social Security. And that's what's considered when you look at either the 25,000 or the $32,000 between single and married filing jointly. Now, here's what the new tax bill does. It does not eliminate taxes on Social Security. It creates a new temporary deduction for seniors age 65 plus. And it is not tied to Social Security. So a senior that is age 65 plus and has not claimed Social Security yet or is eligible but they're still working, is still eligible for the same deduction. So this actually has nothing to do with Social Security. It's just an enhanced senior deduction. So if you're 65 plus, you can claim an extra $6,000 deduction, $12,000 for couple, right? $6,000 each. So you remember how deductions work. So now seniors have an additional amount that they can take off from their gross income in order to arrive at taxable wages. This starts phasing out at $75,000 for single and at $150,000 of joint income for couples that are married filing jointly. Now, this is in addition to the standard deduction, and it's also in addition to the age-based deduction that currently exists, which is $2,000 for single or up to $3,200 on a joint return, either 65 or blind. Now, let me show you what this looks like. This is another chart from Kitces.com, which is they did a great job highlighting the differences. So look at the three colors. The darker blue is the standard deduction that we talked about earlier, 15,750 for single, 31,500 for couples that are married filing jointly. And you see the light blue, the $2,000 current age 65 plus or blind deduction for single, 1,600 if one person in a joint return is 65 plus or blind, and then $3,200 for both 65 or over. Now, if you look on the far right, for example, a couple that is married filing jointly can take the 31,500 standard deduction, $3,200 of the age-based deduction, and now the additional $12,000 senior deduction for a total of $46,700. It's a huge number. And if that couple happens to itemize, let's say they still have property taxes that are high, medical expenses over 7.5% of their adjusted gross income, maybe they're charitable and they give a lot of money away to charity. I mean, if all those combined are higher than that standard deduction of 31.5, they can increase their deductions way beyond the 46,700 total. So this provides a lot of opportunities for high earning seniors to not only save money on taxes, but maybe to do certain tax planning like Roth conversions. And this is something that you should speak to a financial advisor about, and also your accountant, just to make sure that you don't trigger taxes because Roth conversions do cost money when you convert them, but you now have an additional senior deduction that could help you offset some of the taxes you would have paid on a Roth conversion. So this is a great strategy that seniors can use. Now let's talk about SALT, state and local tax. So remember when we were talking about deductions, right? Itemizing your deductions. On your federal income tax return, you can deduct any amount that you pay for state and local tax. So that includes property taxes or sales taxes. It includes state income tax that you pay if you live in a state income tax state that you have withheld from your paycheck. So this is very important specifically for states where property taxes and income taxes are high, like say New York and California. Under the Tax Cuts and Jobs Act, that is the current law that was set to expire as of the end of this year, the SALT deduction was capped at $10,000. So for example, if you had $30,000 in state and local tax, you can only deduct 10,000. Now that gets increased to $40,000 and is going to increase 1% per year from 2026 to 2029. Then it reverts back to $10,000 in 2030 and then becomes permanent thereafter unless Congress changes the law again. There are income phase outs. So it's above 500,000 starts phasing out. By the time you get to 600,000, you're back at $10,000. And this is for all filing statuses except married filing separate, which is half of that, $250,000. So this is the people that live in these states like New York and California are definitely going to be very happy at tax time because of this new law that expands the available deduction. So imagine now, right? If you have $40,000 in taxes alone, plus any mortgage interest, plus any medical deductions over 7.5% of your adjusted gross income, plus charity, you can have a significant amount of itemized deductions that you can deduct from your income. So, good news there. Something that was made permanent was the mortgage interest deduction. So you can deduct your mortgage interest as long as the loan was used to buy, build, or improve your residence, $750,000, right? So if your loan amount is over $750,000, there's a calculation that needs to be made to reduce your overall ability to deduct your mortgage interest. Because if your mortgage balance is higher than 750, you're not allowed to take the entire amount off of your mortgage interest as a deduction. So you have to do that pro rata. Great thing, this is new now. Mortgage insurance is now tax deductible. Mortgage insurance is something that you pay in addition to your mortgage payment when you put less than 20% down on a loan like an FHA loan or even a conventional loan. But if you either put less than 20% down or refinance your mortgage at more than 80% of the balance of the value of your home, you're likely going to pay PMI, private mortgage insurance, or MIP, which is mortgage insurance premium on the FHA loans. That is now tax deductible. So that's another nice little bonus there. It starts in 2026, and there are some income phase outs, $100,000 for individuals and 50,000 for those that are married, filing separate. So still got to take into account the phase outs, but those that make under those limits can now deduct mortgage insurance, which is great. There's been some changes made to charitable deductions, and these are available even if you don't itemize. As a single individual, you can donate up to $1,000. Married couples filing jointly, $2,000, and this becomes permanent after 2025. So this was great because I've had clients that have not enough itemized deduction, so they still take the standard deduction, but they were contributing something throughout the year for charity, but not enough to itemize. Now you can take that $1,000 or $2,000, which is great, right? So it gives you a little bonus in addition to your itemized, or you don't need to itemize, right? So in addition to your standard deduction. Another thing that's different is that the charitable contributions are now subject to a new 0.5% of adjusted gross income floor. So not all of your charitable contributions are eligible if you itemize. You have to basically clear the bar of 0.5%. Think of it kind of like a deductible on insurance. So any amount over that 0.5% then gets to get deducted. And there are some phase out limits as well after that, but that's where it starts. Another deduction that is created for 2027 is a tax credit, in fact, for up to $1,700 for contributions to charitable organizations that fund K through 12 scholarships. So that's going to be another nice bonus there because you can get a credit dollar for dollar and just donate it to charity. Child tax credit is getting increased. Currently is $2,000. It's going to be $2,200. That's made permanent per child. Also, for the first time in history, the child tax credit will be automatically increased with the cost of living. So it'll be indexed for inflation. So that's going to go up every year, which is pretty cool. So the current income phase out still applies. So $200,000 for single head or household, $400,000 for couples married filing jointly. And the credit then still phases out $50 for every $1,000 over those limits. Now, keep in mind that this is for children that are qualifying child. So they have to be 17, under 17 at the end of the tax year. And then there's a relationship test too. So it has to be son, daughter, stepchild, eligible foster child, brother, sister, stepbrother, stepsister, half brother, half sister, or a descendant of one of these, like a grandchild, niece, or nephew. Not provide more than half of their own support for the tax year, have lived with you more than half of the year, and cannot be claimed as a dependent on someone else's return. And there's a few other things there, but if they qualify as your dependent, then you can get this $2,200 credit per child. All right. And they have to have a Social Security number that is valid for employment and is issued before the due date of your tax return. And they have to be either U.S. citizen, U.S. national, or resident alien. All right. Let's see. Qualified business income. So this is for self-employed individuals like sole proprietors, anyone that owns a pass-through entity, sole proprietors, partnership, or S corp. You can deduct up to 20% of the lesser of your qualified business income or your taxable income minus capital gains. This is currently what's been happening for the past few years. So this just gets extended. The one difference now is there's a minimum deduction of $400 if you have at least $1,000 in qualified business income. I'm going to show you a tax return as well so that you see how that looks like. So mostly unchanged. They increased the phase out ranges for higher income business owners and created this new $400 floor. But for the most part, it's the same. There are still phase outs on income and whether or not your business is a specified service, trade, or business. These are the ones that we talked about earlier: doctors, lawyers, consultants, financial advisors, athletes, or artists. So let me show you what that looks like on a tax return. This couple, married, filing jointly, if you look at line 8, had $20,969 of self-employment income, net self-employment income. You notice that their total income was 195,395 on line 11, their adjusted gross income. They get to deduct the 29,200. This is a 2024 tax return on line 12. That's their standard deduction because they didn't itemize. And in addition to that, they get to deduct 20% of their net business income. So you'll notice that 20,969 times 20% is 4,194, which is line 13. So between their standard deduction and the qualified business income, they had 33,394 of deductions, bringing them down from 195 to 162, right, of actual taxable income. So that's still there for business owners, and that is a great thing. All right, limits on loss deductions. This is very new and also something that's different, especially for people that gamble. Like, let's say it's going to probably impact a lot of people, like in places like Nevada. So now you can only deduct 90% of your wagering losses starting in 2026. Currently, you can deduct your gambling losses all the way up to the amount of your gambling winnings. In other words, you can net out your winnings by your losses. So if you had $100,000 in winnings and you have $100,000 or more in losses, you can offset your winnings, in essence, have zero. You cannot deduct the additional losses, but at least you don't pay any taxes. Now, then, under the new law, if you look at this example, if you have $100,000 in wagering losses and $100,000 in gains, you only be able to deduct 90%, right? So 100,000 times 90% is 90,000. So in this scenario, you would have $100,000 in gambling income, $90,000 of gambling losses, even though you really had 100,000 in real life. Guess what? That creates a $10,000 positive income tax now for you because now you have to claim $10,000 of that gambling income you had, even though in reality you had losses. So this is a pretty major change for people that gamble. So definitely keep that in mind. This starts in 2026. Casualty losses under the Tax Cuts and Jobs Act, you could only deduct personal casualty losses if the loss resulted from a federally declared disaster. Now it gets extended. Definition got expanded to also state declared disasters beginning in 2026. The same rules apply. The loss deduction remains limited to losses that are not compensated by insurance, so you can't double dip, and only to the extent that the loss exceeds 10% of your adjusted gross income. So you also have kind of like that floor, similar to the medical expenses with the 7.5%. All right, alternative minimum tax. Most people are not liable for this, maybe not even familiar. The US has two parallel tax systems, one regular tax system, another one called the AMT, alternative minimum tax. Under the tax law, certain tax benefits can significantly reduce your tax amount, as you've seen, right? But the AMT, what it wants to do for people that make over certain amounts of money, it wants to ensure that they pay a minimum amount of tax. So they get rid of certain deductions that get added back to their income in order to arrive at a minimum amount. Now, the new tax bill currently increases the phase outs. So it's 626,350 for singles and 1,252,700 for joint filers. So most people in the US are not going to have to worry about this. Usually about 0.1% of households currently owe AMT. The reason I bring it up though is because there are certain things that you may not be aware of that can trigger AMT tax liability. And one of those things is exercising incentive stock options, ISOs. This has become very common for people to get ISOs issued to them by their employer. And a lot of the times people get a much lower cost, right? So what happens is when you exercise your ISO, the difference between the exercise price and the fair market value is considered a bargain element. That is suddenly included in your income for alternative minimum tax purposes. So if you get ISOs and you're currently exercising those or we're planning on, you definitely want to speak to your financial advisor and or your tax preparer to make sure that you're not triggering A&T, or that if you are going to do it, that you're doing it consciously if it makes sense for you, and that you don't have a surprise tax bill next year, right? And if you're going to, that way you can plan for whether you're going to send an estimated tax payment or something like that. But you want to plan out for your taxes, right? Taxes should not be a mystery. They're complicated, they can be, but they shouldn't be a mystery. This is one of the things that we help our clients with. You see all these different changes. It's very important that you speak to a financial advisor that is very tax focused, like we are, because when one hand doesn't know what the other hand is doing, then there's a lot of missed opportunities. You don't want surprise tax bills. You want to make sure that you can take your taxes and lower them as much as you can legally, right? You don't wait until tax time to just bring a amount of documents to a CPA, because at that point, for the most part, all they're doing is looking in the rearview mirror and saying, okay, here's what happened last year. Here's your tax bill. Maybe there's some last minute strategies you can implement, but you reduce the ability to optimize. When you tax plan, you look forward instead of the rearview mirror, and you can look ahead and say, okay, what am I expecting this year? What else can I do to lower my tax liability? And these are the kinds of things that we help our clients with. So now let's talk about 529 plans. 529 plans are originally were set for college. In past years, that got extended to K through 12, but the new law even expands the definition of qualified education expenses. And there was a limit of $10,000 for these expenses. Now that goes up to 20,000 in 2026. So in a 529, you can put money into it, you can invest it. The money grows tax deferred. And then when you take it out for qualified expenses, it's tax free, which is one of the great advantages of using it for college. In addition to that, some states offer tax incentives as well for putting money into a 529 plan. So they offer that additional tax benefit. So this has been expanded. So the definition now of qualified expenses includes occupational licenses, apprenticeships. In addition to tuition expenses, the new law also allows for college courses taken in high school, educational therapy costs for students with disabilities, costs for tuition outside of the home, and expenses for curriculum materials, textbooks, and online educational materials. So another nice bonus there by expanding that definition. It also expands the eligibility for health savings accounts, also known as HSAs, not to be confused with FSAs, flexible spending accounts. Those are the accounts where you put money pre-tax through your employer, one of your benefits, and you have to use it at the end of the year. Otherwise, you lose most of the benefit. There's a small amount that you can carry over to the next year. But the HSA is a triple tax advantage account if you use it right, where you can put money pre-tax into this. You can invest the money within the account. You don't have to use it that year. And then later on, when you use it for qualified expenses for healthcare, it's tax free. And if you don't use it for qualified healthcare expenses, if you wait until you're age 65, then you just get treated like an IRA and you pay taxes on the money you take out. But if you use them right, it could be triple tax advantage. Currently for 2025, the contribution limit is $4,300. You have to have a high deductible plan. And if you're a couple, $8,550 if you have coverage for your family. And people that are 55 plus have an additional contribution amount that they can do on top of those limits. Now, the new law expands the plans that qualify as high deductible health plans. So it includes now the bronze and catastrophic plans. So that is great. So more people are going to have that eligibility for HSAs. And it also includes direct primary care arrangements. And that's a healthcare model where patients pay a recurring fee to their primary care physician and leave the insurance out of it. So now that also qualifies you for a high deductible health plan. So I work with a lot of high earners in our practice. When they're already maxing out the 401k, the next place I look is to see if they have a high deductible health insurance plan. And if it makes sense for them to do one, then we open up the health savings account to max that out as well. Because remember, any amount you put into this, just like any amount you put into a 401k, it's pre-tax, so it lowers your taxable gross wages that get reported on your W-2, right? So anything you can do to bring the taxes down is helpful, right? And then on top of that, you're investing the money for later. All right. Another thing that's new, it's tax favored accounts for newborns. There's a new child savings account. These are like IRAs, individual retirement accounts, but for kids. One difference is that they don't have to have earned income like with IRAs. So up to $5,000 can be contributed. This is not tax deductible, but it does get to grow tax deferred. It has to be invested in a low cost mutual fund or exchange traded fund, an ETF that tracks the S&P 500 index or another index comprised primarily of US companies. Again, contributions are not tax deductible. Plenty of sources can contribute, including employers, up to $2,500 annual cap. That can be opened and funded on behalf of any individual that has a social security number from birth up until the year before the year in which they turn 18. No distributions are allowed before age 18. They are allowed after age 18, but they might be subject to some early withdrawal penalties because it's designed for retirement. So the contributions wouldn't be taxable, but the earnings on it could be taxable and also subject to an early withdrawal penalty. All right, let's talk about energy credits. This is also very important. There's a repeal of energy credits. So if you were thinking of buying an electric vehicle, currently you can get a credit of up to $7,500 for new cars and $4,000 if it's used. That's ending September 30th, 2025. So if you were on the market for an eligible vehicle and if you're eligible for the credit, make sure you do so before September 30th, 2025, because now that's going away. Another thing is energy efficient home improvements. The credit up to $1,200 for the cost of energy efficient things like windows, doors, insulation, or heating, cooling equipment, and so on. Home energy credits. That's going away as of December 31st, 2025. And then things like electric vehicle charging equipment that's installed in your house. That credit is going away as of June 30th, 2026. So if you're planning on doing any of these improvements or buying an electric vehicle, make sure that you're aware of these dates and you execute before then. So you take advantage of the current existing credits that are going away. Another thing that is going away is related to student loans. So they kept two things in place. One is it permanently extends the Tax Cuts and Jobs Act exclusions from income for student loan debt that is discharged due to either death or disability for students that have a Social Security number. Student loan payments under the employer provided borrower assistance program up to $5,250 annually are still not included in income. So those two things stay, that's still good. The bad news is that certain loan programs are going away. The Save, which was took over kind of like the Repay, the Pay, these are all different income-based repayment programs. You can learn more about them at studentaid.gov. They are based on your income, your family size, and so on. So they vary, but ultimately, what the new bill does is that it repeals all of those. They'll no longer be available except for two plans: the legacy income-based repayment plan and the repayment assistance plan. So again, you can go to studentaid.gov to learn about the two differences. If you have student loans, you may have to change to one of these two, or perhaps even refinance with a private lender and compare which one makes more sense for you, because private lenders usually are not as flexible with certain things that federal student loans provided. Grad plus loans are eliminated. There are going to be caps now on borrowing for grad school, professional degrees, and parent plus loans. And also in 2027, borrowers facing unemployment or economic hardship will no longer be able to apply for loan forbearance or deferment, which is pretty big. That was one of the major advantages of federal student loans. Now, this creates an opportunity for private lenders to fill that gap, but I don't know if they'll be as generous necessarily. So you definitely need to start planning ahead because these changes are coming down. All right, let's talk about estate planning. I want to tell you just some quick changes regarding estate, but I want to talk about estate planning in and of itself first so that you understand what it is, why it's important, and why it matters, even if you're under the exemption amounts. It is not just for the ultra wealthy. I remember every time I used to hear the word estate planning, I thought this was something for the Rockefellers. Like, I don't have an estate. Who has an estate that I know, right? But that's not. the case. Everyone really could benefit from estate planning. So, what is estate planning? It is determining how your assets will be managed, distributed, or preserved after death, right? So, what happens to my stuff when I die? Now, that's only one of the things. You can also determine how your financial obligations should be managed in the event you become incapacitated. So, you can designate someone to act on your behalf, like a power of attorney, to be able to do certain things, right? Pay your mortgage, pay your bills, act on your behalf. Because sometimes, unfortunately, there are things that happen where people, maybe they suffered a stroke or heart attack and they're just laying in the hospital and they have no way of acting for themselves. So you want to make sure you have these kinds of things in place. On your estate plan, you could provide for a surviving spouse and children, establishing legal guardians for your children, very important. If you don't leave a will where you designate a legal guardian for your children, and let's say both parents were deceased, then a court would have to designate a legal guardian. And that might not be the person that you want it to be the legal guardian, right? So you want to leave these kinds of things in place ahead of them. Hopefully, it never comes into play, but you want to make sure that you do have it. Estate planning could help you minimize taxes as well, setting up your funeral arrangements. Also, things like a living will, where you can designate what happens. Like, do you want to be resuscitated? As far as like pulling the plug, I mean, all kinds of things. I know nobody wants to have those conversations because they're very morbid and difficult. I've been through the process myself, but it's something that you do once and then you update throughout the years as things change, right? You might change beneficiaries or you might acquire more property or sell property and you give them those updates, right, with an estate planning attorney. So some of the tools that are used in estate planning are trusts, wills, powers of attorney, healthcare proxies, and living wills. Those are the most common ones. So I highly recommend that even if you're not ultra wealthy, if you don't have even the basic documents like a will, powers of attorney, healthcare proxies, things like that, speak to an estate planning attorney. And this is something that if you're working with a financial advisor, they can refer you to one. And this is what I do as a financial planner. I have with my team, we have resources that we can offer our clients, just referrals of professionals that we trust. So these are the changes for estate tax exemption. It increases the individual exemption to $15 million per person or $30 million per couple starting in 2026 and will further adjust for inflation. So, what does this mean? That if you have less than $15 million as an individual or $30 million as a couple over your lifetime that you plan on leaving, you don't have to worry about it, because estate taxes can be as high as 40% on the federal side. And some states also have their own estate tax. But this is why I preface it with estate planning is not just for the ultra wealthy, right? So most people probably don't have to worry about this, right? Most people are probably not leaving 15 or $30 million, but there's so much more that you can do to protect yourself and your heirs. I mean, think about the fact that even you hear this with the ultra wealthy that died without an estate plan. That's also a problem. And not only from a tax side, but imagine your heirs are grieving. The worst thing now that they have to do, if you didn't leave anything in place like it will, they have to go to court. It's called probate, right? This becomes a public thing. The court now has to approve an administrator of your estate. And it's a long, arduous process. And it probably ends up being even more expensive than if you hired an attorney in the first place and did everything. And this is another way to ensure that things happen according to how you wanted them in the first place. So something you definitely want to consider. So I'd like to thank you all for watching. If you are interested in a consultation, you can send us an email, client services at buildabetterfinancialfuture.com. You can call us or scan the QR code. It takes you directly to our calendar online to schedule an appointment. Our team, we're certified financial planning professionals. We have a tax background, and we can coordinate with the estate planning attorney and your other professionals to make sure that one hand knows what the other hand is doing, planning ahead to set you up for success. So thank you for taking the time to watch this webinar. You can visit us at buildabetterfinancialfuture.com. Be sure to listen to the podcast as well, and look forward to connecting with you. Thank you.